As volatility rocks global markets today, Kalshi announces a bold shift into commodities, accompanied by a market expansion and a dedicated hub. Traders watching price shocks in oil, copper, and corn see an opportunity to hedge, speculate, and compare event predictions against real events. The move matters because it blends prediction markets with tangible assets, offering a new tool for risk management when headlines swing markets from supply disruptions to weather shocks. For retirees and institutions alike, this signals a potential bridge between traditional futures liquidity and user-friendly, rules-based forecasting. Ferocious price swings underscore why this matters now. Kalshi is expanding its platform to include commodity event contracts, letting users wager on outcomes like supply levels, price thresholds, and regulatory decisions around key goods. In practical terms, you can purchase a contract tied to whether crude oil moves above a price on a given date or whether copper inventories fall below a set target. The expansion also includes a new hub for education, liquidity, and product development, aiming to attract brokers, hedge funds, and retail traders. By turning price moves into tradable events, Kalshi links real-world fundamentals with dynamic forecasts and transparent settlement rules. Markets respond as demand grows. To appreciate Kalshi's move, consider the history of prediction markets and commodity trading. Prediction markets emerged as a way to aggregate diverse opinions into probabilities, helping decision-makers price risk. Kalshi obtained regulatory approval to operate as a designated contract market, joining platforms that once only offered political or weather events. Commodities, by contrast, have deep liquidity, visible inventories, and benchmark prices watched by producers, traders, and governments. The idea of combining event contracts with real assets is not new, but a dedicated commodities hub signals a shift toward mainstream, rule-based forecasting that can coexist with futures and options. Early signs show institutional interest forming around the new hub. Prices in related exchange-traded products may react as more money seeks exposure to commodity events rather than traditional bets on spot prices alone. Risk premia could compress if predictive liquidity rises, while hedgers gain entry points outside conventional futures. Market data vendors report spikes in search interest and trade flow on days with major supply news. Critics warn that prediction markets can exaggerate price discovery if liquidity remains uneven. Still, the narrative of Kalshi bridging forecasting with real-world assets is gaining attention across banks, energy groups, and asset managers. Impact spans producers, traders, exchanges, and platforms. Energy majors relying on price forecasts could hedge end-of-quarter risk, while mining giants may view the hub as a new analytics layer. Exchanges and brokerages may integrate event contracts into workflows, distributing liquidity to retail accounts that previously shunned complex futures. Hedge funds could test tail risk strategies against regulatory outcomes, and pension funds might see more predictable hedging costs rather than outright bets. Startups providing data, analytics, and settlement infrastructure stand to gain as a new product category matures, aligning incentives across participants in the commodity cycle. Across markets today, geopolitics and macro trends frame this expansion. Supply chain fragilities, sanctions, and shifts toward energy transition influence commodity price dynamics, making hedging harder to time. Central bankers balance inflation pressures with growth impacting carry costs and liquidity. Currency moves, especially a strong dollar, can magnify contract payouts and dampen speculative appetite. The Kalshi hub sits among a web of regulated venues, exchange-traded funds, and over-the-counter deals that react to weather events, strikes, and policy changes. As markets price uncertainty, a dedicated hub could improve transparency, reduce information asymmetry, and create more data for policymakers evaluating commodity security and price stability. Smart money is watching and testing. Some hedge funds have begun small allocations to commodity event contracts to gauge liquidity and settlement reliability, while others wait for deeper data and credible benchmarks. Banks and wealth managers bake Kalshi into risk dashboards, treating the hub as a supplementary signal rather than a pure bet. Retail traders, attracted by transparent rules and lower barriers than futures, are exploring education hubs and community forums. The consensus is cautious optimism. If liquidity grows without spiking volatility, Kalshi could become a mainstream tool for forecasting, rather than a fringe experiment. Regulators watch closely as volumes build. Like any new market, risks lurk. If liquidity remains thin, early prices could be volatile on surprises and rumor, undermining trust in settlement. Regulatory shifts or a mispricing of macro risk could trigger abrupt losses for participants surprised by outcomes. There is a danger of crowding into a single narrative, where forecasts overreact to headlines and price moves disconnect from physical supply realities. Operational risk also matters. Outages, cyber attacks, or bugs in settlement or oracle feeds could undermine confidence. Finally, a sudden shift in commodity fundamentals or a broader liquidity crisis could erase gains and deter long-term adoption altogether. Retail investors can respond with a plan built on patience and learning. Begin with a simple allocation to education rather than immediate bets, using Kalshi's hub to understand contract types, settlement rules, and price triggers. Practice first with a paper portfolio or small position in a few well-known commodities like crude oil or copper. Use stop-loss ideas, diversify across at least 3 asset themes, and avoid putting all capital into a single event. Track outcomes against reasoned scenarios, not headlines. Build a routine of review and gradually scale exposure as comfort and liquidity improve. With discipline and oversight, Kalshi's Commodities Hub could become a meaningful node in the evolving ecosystem of financial forecasting, linking real-world events with contract-based insights. Investors will watch pricing reliability, settlement clarity, and user experience as they determine adoption across pension funds, family offices, and retail accounts. If the hub achieves scalable liquidity without sacrificing governance, it may redefine risk transfer and information flow in markets, encouraging data-driven decisions. Regulators will evaluate outcomes, data quality, and disclosure norms as more assets become forecastable by event. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.